Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, Michelle Cluver, Portfolio Strategist at Global X ETFs, to discuss the intersection of CPI data, the employment market, and Fed policy, and what that means for the macro environment. Michelle, it's great to have you with us. Welcome to TradeTalks.
Thank you very much. Really great to be here in the studio with you, Jill.
You got it. And we got the CPI data this morning up to 3.2%. What are your thoughts around that? Do you think it's going to keep the Fed higher for longer at this point?
Well, I do believe longer term the Fed will be higher for longer, but at the same time that 3.2% number was really encouraging. Markets were certainly expecting closer to a 3.3%, so that headline figure, while it did tick up for the first time in a year, it is an encouraging read, and especially looking at the core figure, we're seeing encouraging data that it's starting to slow. We are seeing moderation in the economy, and that's what the Fed will certainly be looking at.
But shelter and food, I mean, we're seeing the acceleration there, and those are the two things that impact everyday people. I don't know about you, but anecdotally, everything still, it feels more expensive than it has been in quite some time, even more so than last year.
Yes, well, that's also even the disinflation narrative. It's not talking about deflation, it's just a slowing of the price increases. And so on the food side, while we have seen the slowing, we still certainly are seeing inflation pressure, and that is really a concern. Obviously on the rent side and the shelter component, that's making up close to 90% of CPI this month. And so that is the sticky component of CPI that the Fed is still concerned about, particularly because that does fit into the core, which is the area where they will be a lot more focused on. And so while this reading does potentially increase the likelihood of a pause, there is still a lot more data dependency on the next two data points that are coming out, that labor market non-farm payrolls for next month, as well as the next CPI data point. And so while the Fed is data dependent, this is a good read, but there still is a lot more data that could come.
Because it seems like they're hyper-focused on that core number, and it's still not anywhere close to 2%.
It's moving in the right direction, but it's moving very slowly.
So it sounds like rate cuts for 2024, for 2023, possibly even the first quarter of 2024 is not really in the cards at this point.
Potentially first half.
Right. What about the employment market? Are they seeing any improvement there with the data?
I'd say there's two parts of it. So on the wage inflation side, that's still concerning. 4.4% reflected on the non-farm payrolls is still too high for the Fed's, what the Fed's looking for. But at the same time, we are seeing moderation in job growth. And so that is encouraging. It does still reflect a robust economy, which is encouraging for the growth of the economy going forward. But the wage growth side is still concerning.
I guess there's just so many different things coming at the Fed here. Not only is the labor market tight because there's just not enough people to fill the jobs that are out there. In order to keep up with increased cost, people are going to have to get paid. So it's not surprising to see that wages are higher, but then they're also trying to bring that down to get the data that they want to see. But there's a big tug of war going on with this.
There certainly is. But if we look at the CPI numbers from today, there were two actually encouraging elements within the core CPI. What you're seeing in terms of used car sales, the prices there are coming off quite strongly. Additionally, airline tickets, those discretionary items, we're starting to see consumers actually take a step back. And that's what the Fed wants to see.
Yeah, I mean, what was airline down nearly 8%, I believe it was?
Yes, and it's the fourth consecutive month of decrease. And so we're definitely seeing a movement in the direction of consumers thinking a little bit more before they purchase.
So let's get your outlook for the remainder of the year here. When you think about portfolio positioning, what are you recommending to investors with this macro backdrop? We just got through earnings season, which was okay.
Yes. So it's certainly still, it's a better than expected environment, but we are still seeing headwinds. So while we're not expecting recession in 2023, it doesn't mean that growth isn't slowing. And so we're still in a challenging environment for the consumer. If we're looking at consumer balance sheets, they came out of the pandemic really strong. But some of that strength is starting to weaken a little bit. And so if we're looking at autos as well as credit debt, there's a little bit of an increase into that level back to pre-pandemic levels, which means that there's a little bit more pressure onto the consumer, which are areas that we're starting to focus a lot more on. In terms of portfolio positioning into this environment, we're still remaining a lot more quality oriented because we believe that it's important to have a solid core because there are still uncertainties. While we are in an environment which is a bit more Goldilocks at the moment, there are still risk factors out there that portfolios should be positioned for as well.
All right, Michelle, we appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.